Hello traders, you're welcome to another video on this channel. In this video, I'm going to be presenting to you the entry model types that you can use to enter your trades and execute with absolute precision. So if you are new to this channel, you are watching Forex King and I am called Francis Xavier and I'll be presenting to you for you today. So stay tuned and let's go in. So first of all, we are going to look at the entry models. Each entry models will be illustrated with a diagram and an example. So we start off with a sweep entry model, right? So what is a sweep entry model? A sweep entry model is just a model whereby price happens to it approaches your POI, like this case, and instead of price closing above it, it sweeps above it with a candle body. So when price sweeps above your entry with a candle body, what are we waiting for to get an entry, right? So once this happens, once we have this sweep of POI or an inducement, your POI must not be a valid POI, right? It can still be your inducement. So once this happens and the market happens to give you a change of characters, so this is where we confirm that this market wants to give us a downside move. So once this sweep occurs here, you look for a sell. Once this sweep occurs here, you have your change of characters. When price returns to the origin, you can look for a sell. So what are the scenarios here, right? First scenario is you can use the whole of this zone. You can use the whole of this order flow as your point of interest in this case to sell off and you target this low. Second scenario is you can refine it and use the candle that left that sweep to sell. So either of these is just fine and you should have a good risk to reward with this, and the other one you have a pretty decent risk to reward. So what should you watch out for? First of all, you need to make sure that this price sweeps. If you are watching at price in the 1 hour time frame or in the 15 minutes time frame, once this sweep occurs, you can switch down to maybe if you are watching at in a 1 hour time frame, you can switch down to the 15 minutes or the 5 minutes time frame to look for this change of characters. So once this occurs in your bigger time frame, you need to switch to a smaller time frame to look for your change of characters, right? To switch to the appropriate time frame and you can get your sell off from this zone like this, right? This is how your sell off should look like this. That's how your position will look like this. And this will be it. So let's go into the charts. Let's go into the chart and I'll show you exactly this scenario, right? First of all, here you can see we had a break of structure here. The market took out the inducement and we had a break of structure. So on a bigger time frame, right, this is an order flow. I don't know if you don't know what order flow is, you can watch my previous videos. You know, you get to understand what order flow is. So this is an order flow, right? And when the market tapped into this order flow, we were anticipating for the market to rally back up to the origin of where this market tapped into our order flow and gave us a change of characters. But this market had a zone here. So when the market was rallying up to this zone, the market happens to sweep our inducement. Now, when I say sweep, I mean the market push above that inducement and did not close, that candle did not close, candle body above that inducement. So when that happened, the first sign we are looking to short our position is if the market is going, as the market given us a change of character. So we waited for a change of characters and this occurred here. So once this occurred here, we waited for the market to return to the origin that gave us that sweep of the sweep, right? So once that happened, we got our position and we target the low. We target this previous low where we know our next break of structure is going to be. So what are the differences in this entry as compared to the other one? If you look very critically here, you see that this leg, we don't require an inducement on this leg. This is so because the market has already taken out liquidity. You know, inducement is a first, it's our first form of liquidity that we consider when marking out structure. So now this sweep here indicated that the liquidity above this high has already been grabbed. So we necessarily don't need that inducement here to sell. That is why you see that we can comfortably sell off this zone, right? There were two entries here. There were two entries here. Either you sell off immediately after this candle closes and you have a smaller risk to reward, or you can wait for the origin, for price to return to the origin and you sell. So that is the first scenario. And where is our target, right? Make sure that we target where we know that our next break of structure is going to occur, which was this low. So you can see this trade played out and hit our take profit. If we go ahead, we are also going to see multiple of these scenarios. And by the way, right, this works for majority of the pairs, majority of the pairs. There's a scenario here, right? There's a scenario here. If you are keen, we had this low here, this low got swept, right? So where is our change of characters? This is our change of characters at this zone. That's our change of characters. And what do we wait for, right? You just need to wait for price to push back down. In this case, now we can use the wick of this candle because this wick is unmitigated. So we can use the wick of this candle as our entry. Or once price breaks above here in a smaller time frame, we can use this as our entry and we'll put our stop loss here, right? In this case, since our break of structure was not that clean here, you can use a Fibonacci and you target at least 1:3. But if you refine it down to this zone, you're going to have an easy 1:3, right? Something like this. So that's a trade I did not cash as well. Majority of the markings you see on my chart are trades that I got. So let's go to a different trade I had here. So you see this zone here, right? We had a sweep here. Now this one was a pretty tricky trade. This is a zone here. We had a sweep here. Now this sweep comes from a bigger time frame, right? Sometimes you see in the bigger time frames you have a clean sweep, but when you start dropping down to 15 minutes, you're going to start getting something like this. So once that sweep occurred here, we waited for a change of characters, which was this zone here, and we sold. When price returned back to our zone, we sold here, putting our stop loss above here. I gave some room here and nearly hit our stop loss since it came above this zone again to sweep it. So after that, it went directly to our TP. So let's go to the next entry module. Okay, this next entry module is what we call a flip entry module, right? So this happens when price, like the market, gives you gives you a break of structure, then comes back and taps into your point of interest. Now, what happens normally is when the market is coming down, right? The market is creating lower highs and lower lows. So when this market finally taps into your point of interest, it rallies up and it makes as if it wants to respect the last internal lower high here, then push down a little, and then you finally have a change of characters and the market rallies up. So we see here that what are the key points in this entry? First, we have a point of interest. We have a point of interest here. We need to have an inducement to make our point of interest valid. This inducement before your point of interest, it makes your point of interest valid. Now we have the return, the corrective leg, which is making lower highs, lower lows. These are called internal structures. So when the market approaches this year zone, instead and taps the zone, instead of the market to just tap and give us, to just tap and give and take out the first lower high, the first internal lower high to give us a change of character, it taps and instead it respects the demand that that lower high created. It makes as if it wants to respect the demand, right? After that, it finally breaks above that lower highs, giving us a change of characters. So when this happen now, where is your point of interest? In this case, your point of interest now is this zone. So now this supply zone here now turns to a demand zone. So this is S to D. So this is what is called supply to demand zone. It's also called a flip zone, right? We have two scenarios. It can either be a bearish scenario or a bullish scenario. But in this case, we are going to focus solely on this bullish scenario here. So what do we need to enter using this entry criteria? First, we need an inducement to enter, because this has not taken any form, this has not swept any form of liquidity. So there is no way for us to just enter directly. So we need an inducement to enter off this zone. So now when the market comes back down, we take our position from this zone. When you take your position from this zone, your stop loss, there are either two ways which you can play this. You can either take this like this, putting your stop loss just below this low, or you can use this, you make your stop loss a little bit bigger to be more safer, right? Put it below this zone and you target where the next break of structure is going to be. So these are the two scenarios in this case, and we expect prices from here to rally straight up. So this is just the brief diagram of it. And if you are suffering with these entries models, right, you can just screenshot this and you use it later, or always look at it. The more you look at it, the more you become familiar with the entry model. So let's go straight into the chart and let me show you what I'm talking about in this diagram. Okay, so here we are going to use this 1 hour time frame as our bigger time frame. So now from here, right, we have a point of interest. We have a point of interest here. If you look at it, it's quite a big point of interest. So when the market came back, right, we had an inducement here. When the market came back, it tapped into this point of interest. Now, this is the mind you, this is the 1 hour time frame. So let me switch down to the 5 minutes time frame so that we can get our entry. Okay. So this is the 5 minutes time frame here. This is the 5 minutes time frame here. And what we see, allow me to position it very well so that you can see well. Okay, what you can see from here is this market pushed down, right? This market pushed down. So this was our last internal structure high, right? So this push here, creating this internal structure high and creating this internal structure low here. So we're expecting price to give us a change of characters and continue to the upside. So what price did here is, this was our last demand zone in this case. So price push and reacted off this, sorry, this was our last supply zone. So price push and reacted off this supply zone. When it reacted off, it created a demand zone here and finally gave us a break of structure to the upside. Now, after this break of structure, right, we had our inducement here. What So this inducement acts as our liquidity before our point of interest. So we had this flip zone. This supply zone turned into a demand zone. So when price eventually came back, collected our inducement and tapped into our flip zone, we bought. We bought from here and we targeted the high of the high in the bigger time frame. Obviously, we could have seen, if this entry should have failed, we should have used this one here. But I did not want to risk that much, so I incorporated nearly the whole of this POI. The whole of this POI, because this was our second entry. If I wanted to use sniper, I should have used this, right? You see that this risk to reward would have been massive in this case, but I don't go for massive risk to reward ratios. I go for what I think is accurate and sure. So if you should have missed this initially here, you should have still gotten a chance to get involved in this position right over here, right? So you can see that after the market gave us this break of structure, it eventually came back for a re-entry here, leaving inducement here and another point of interest which you could have bought from and had the chance to put your stop loss just below this zone. So let's see the two scenarios in this case and let's see how much we could have risked and how much we could have gotten as our reward. So this is the first scenario and you can see, right, this stop loss is very small. It's very small. This was a 1 is to 16 risk to reward. It took time to play out and we could have even reduced it to 1 is to 27 risk to reward here. But we play safe and we reduce it. We kept it to 1 is to 16. This trade, I shared it in a telegram, in a free telegram community, and people made massive money from it. So if you are yet to join the telegram community, I'll be leaving the link in the description of this video. So make sure you check it out and you join the telegram community. You'll be learning a lot from it and you'll be benefiting a lot from it as well. So that's it for this entry model, and we are going to be going over to the next entry model, which is the most widely used entry model by anybody in the trading industry. Anybody that trades the smart money concept, this is the most widely used concept. Okay, so this next entry model will be the our most typical entry model. So what we normally need for this entry model is we just need for the price to tap into a valid point of interest, then gives us a change of characters. So once price takes our inducement, taps into a valid point of interest, gives us a change of characters. What we wait for is we just wait for an inducement. So this acts as our liquidity before our entry. Sorry, I mislabeled something. This is our change of characters here, and this is our inducement here. So this acts as our liquidity before this our point of interest. And normally once this is taken out, we look for an order block below it or a demand zone, and we can buy off straight from this entry and we target where our next break of structure is. So there are two ways whereby you can keep your break of structure. You can choose, you can keep your stop loss. You can choose to put your stop loss below this low. You can choose to put your stop loss below this immediate low. However, below this low is safer and below this low offers a high risk to reward ratio. It depends on what you prefer in your trading. So this is the scenario here. You can take a screenshot of this, and while I move over to the chart to illustrate this. Okay, so this is our zone here. This is the zone here, right? This zone has inducement taken before it. This is our inducement, and we have this order flow here. Now price has tapped into this order flow. This is a 1 hour time frame. So once that happens, I switch over to my 5 minutes time frame, which is the corresponding time frame for which is the entry time frame for of the 1 hour, right? If you are trading SMC as I am, that should be your entry time frame. So let's look at where that happened. Okay, so this is where that scenario happened, and you can see immediately after that we have a change of characters, right? This is where our change of characters occurred here, and our inducement. This is where our inducement is. Sorry about that. I'm not supposed to be using that line. So this is where our inducement is, right? So this is our first liquidity that needs to be taken out before we can enter this trade. So you can look, if you look critically here, you see that we have some sort of invalid entry here. So after that, what do we do to look for? We look for our demand zone or our other block, right? So if I refine it down here, this is where I extend it. Anytime the market taps into this zone, I can get my entry. So from here, you can see that when the market came into this zone, the market rallied up. The market rallied up massively. So from here, you are targeting this previous high. You're targeting this previous high. And there are two scenarios, like I said, you can put your stop loss. You can choose this low here, or you can choose this low. If you choose the first low, you have about 1:4. If you choose the second low, you have about 1:9 risk to reward, right? 1:9. So that's it. The market missed this TP by a few pips, but this should be considered a winning trade because this played out about 90%. And if you're a good trader, you should not come back. You should not enter a loss from this. You should have taken partials maybe around here, around this high, around this other high, around here. And also you should have been wary of this extreme supply zone here. So guys, that will be all for the video. If you are new to my channel, please subscribe, follow me, leave a comment and tell me what you think about this. And these trades you see me sending here, I've sent them to the Telegram community. These are not just for video sake. If you check my Telegram community, you are going to see lots and lots of this. So make sure you check it out. And yeah, have a nice day. God bless you all. Peace and out. And I'm also offering one time. I'm also offering a mentorship, and I'm taking just one student at a time. The price is $150. If you want to, then you can write me on Telegram. I'll be leaving the link to my Telegram in the description. Peace and out.